In this video, I want to explain to you why I choose to use my stop loss as a zone instead of just a skinny line. Okay, so as you can see, I have the purple line drawn under the candles that I entered. So where I originally entered was a bullish reversal. Okay, a bullish reversal is when the green candle takes out the top of the red candle next to it, and there's some power to it. So not those little small candles, but a larger one like this one here. The problem is I entered it prematurely because the green candle didn't in fact close above the red candle. It wicked above it, but then it pulled back, but I was already in. So I expected it to come back down and challenge my stop loss, okay, with the red candle. But I try to give, before I stop out, because my stop loss is a zone, I try to see what the next candle is going to do before I exit the trade. So I give it a chance to kind of flirt with my stop loss. So I like to keep my stop loss at like a 5-cent range, 5 to 10 cent range. So as you can see, the purple line is at 661.32, and the bottom of the red candle that crosses the line is at 661.21. So that's about my zone, about that 10 cent zone. And then once this green candle came and almost took out 80% of that red candle, I was confident that we were going to continue to the upside. I wasn't confident enough to add a contract because at that point in time I might have still been negative. But as you can see now, we have pushed through the moving averages, and there's obviously been a break of structure to the downside. That's one of our trading terms, all right? But really it's a reversal. It's a bullish reversal. The move down, the trend has changed and turned to go the other way. Now I'm looking for a 20% return. I consistently scalp 20% returns to lock in profits, to maintain a level of consistency. However, this trade is a prime example of having a profit-taking strategy and leaving money on the table. All right, so I'm starting to realize that my 20% wins are leading to money being left on the table. Initially, I would take profit right when a reversal happened. But now I'm noticing that I'm taking profit and the trade, the play is continuing to move in the direction that I chose. Now, I don't want to get greedy and start going above and breaking my rules. However, I do want to perhaps develop a strategy that would allow me to take some of the profit and then stay in the play. And the best way to do that is to not be a one contract trader. All right, so right now we are building our account up with strong trades, a good foundation for consistency, focusing on percentage. And if I want to make more money, I am going to stick to my percentage for my initial contract, and then I'll let any additional contracts run or continue to move in that direction, bringing my stop loss up to where I got out at. So worst case scenario, the second contract will break even at 20%, but I'll leave that second contract in there with an opportunity to move beyond that. All right, I hope that makes sense. So we can't just have an entry and exit strategy, but to maximize our trades, our experience, and our time, we need a profit-taking strategy. And a profit-taking strategy is to add contracts to your winning plays, take profit at 20%, and then allow the second contract to run. All right, you can allow the second contract to run for another 10%, another 20%. So now you take profit on the first contract, you allow that second contract to move further into profit, and then you can choose what will be your rule for taking profit on that second contract. But the biggest rule should be to bring your stop loss to break even, and the minute that second contract pulls back to flirt with that break even point, you take profit on there, because now you're taking both contracts at 20% while giving one of the two contracts an opportunity for more gains. All right, I hope that makes sense. So as you can see, we came here, we touched the 50 period moving average, which is often a resistance level. However, instead of snatching at our profits, we double down and we are waiting for our 20% move. This could have very well reversed on us, but we are working on our 20% return. We're not focused on dollar amount. We're just focused on the return. Because if we add contracts, if we go up in contract size, so instead of buying a $150 option with a 33 delta, maybe we go and we buy a $350 option with a 55 delta. We're still going to watch for a 20% move. The dollar amount will change, but the move on the chart does not. So if you have a system for trading, you want to maintain your strategy, your profit-taking rules. You want to develop your rules as you develop as a trader. You want to focus on risk management, consistency, discipline, and you have to know your options trading math. A lot of people do not know the math of options trading. They're getting in, they're following the crowd. They don't understand delta. They don't understand the bid and the ask spread, market orders versus limit orders, stop limit orders versus a stop loss. So you need to understand how the math, these micro math equations, factor into your wins and your losses. All right, so here we are approaching 20%. Beautiful. We're going to take that. Again, if I had two contracts on here, I may have been able to take this profit here, right? And then have a second contract to run and maybe flirt with this second candle. So I can take this 20% here. Boom. Taking 20% profit here. This pop-up is because Webull allows you to trade with unsettled funds. All right. And then boom, had I had a second contract, I would have been up 38 on one. I would have been in the second contract, and then this next candle would have moved me into profit. Peace and love, and I hope you get rich. I'll see you in the next video.